For the past 48 hours, brokers across Wall Street have been making calls they never make, to clients holding silver at $80 an ounce, telling them the same story, word for word. A $6 billion wave is coming, a rebalancing event, a guaranteed crash within 72 hours. But here's what they're not telling you. The math they're using is designed to make you panic, while someone else covers a 4.4 billion ounce short position. Before it explodes, the question isn't whether the selling is real. The question is, who's buying on the other side? Welcome to Currency Analyzer, where we don't follow the narrative, we dissect it. Now, before we expose exactly what's happening behind these broker calls, I need to ask you something. The way your generation used to subscribe to newspapers every morning, because you wanted the truth, not the headlines, that's exactly what this channel delivers. So do me a favor, hit that subscribe button right now, the same way you'd bookmark a page in a book you don't want to lose. And tell me, where in the world are you watching this from? Are you in New York, London, Singapore, or somewhere else entirely? Drop your location in the comments, because what I'm about to reveal affects every single market, everywhere. Now, let's begin. Something unusual is happening in the financial world, something that doesn't happen often. And when it does, it means someone is desperate. Over the last 2 days, a pattern has emerged. A pattern so coordinated, so precise, that it cannot be accidental. Brokers are calling their clients. Not just any clients. They are calling people who hold silver. People who bought silver years ago when it was $20. People who held through $30. People who are now sitting on massive profits at $80 an ounce. And they are all saying the same thing. You need to sell right now. Now, here's what makes this strange. Brokers don't usually call their clients to give free advice. They call for 2 reasons only. First, to sell expensive products that make them commission. Second, to demand more money when a client is losing. They do not call to help people protect their profits. They simply don't do that. But this week, the phones are ringing everywhere, from London to New York, from private wealth managers to retail trading desks. The message is identical. The script is the same. They are telling clients that a crash is coming. Not just a small pullback, not just a normal correction. They are using words like meltdown. They are using phrases like structural liquidity event. They are painting a picture of disaster, a disaster that will happen in the next 72 hours. And here's where it gets even more interesting. They're not just telling people to take profits. That would be normal advice. That would make sense. No, they are going further. They are actively recommending that clients open short positions. They are suggesting put options. They are pitching inverse ETFs. They are telling their own clients to bet against the strongest bull market in precious metals that this generation has seen. Think about that for a moment. Silver has gone from $30 to $80. It has nearly tripled in value. And now, at the peak of this rally, suddenly, brokers care about their clients' downside risk. Why now? Why not when silver was at $18 and actually cheap? Why didn't they call then and say, this is the opportunity of a lifetime? They were silent back then. In fact, many of them were publishing research reports saying silver would drop to $15. They didn't call when it broke $50. They didn't call when it broke $60. But now, at $80, with the market surging, they are suddenly concerned. This raises a fundamental question, a question that every investor must ask. Who benefits from this? In Latin, they call it cui bono. Who gains if millions of retail investors panic and sell their silver? Who gains if grandmothers and retirees dump their positions in fear? The answer is simple. The people who are short, the people who sold silver they didn't own, the people who bet that the price would go down and lost that bet. For every seller in the market, there must be a buyer. If brokers are telling everyone to sell, then someone, somewhere, is planning to buy. And that someone is likely the same institution that is trapped in a losing position. The major banks, the bullion dealers, the large financial institutions. They are not calling clients because they care about retail investors. They are calling because they are desperate for liquidity. They need sellers. They need volume. They need people to panic. Because they are sitting on short positions that are bleeding billions of dollars every single day the price goes higher. Every dollar that silver rises costs them massive losses. Every ounce they are short becomes more expensive to cover. And right now, according to market data, the short position in silver is approximately 4.4 billion ounces. That is not a small number. That is larger than multiple years of global mine production. And the price is not going down, it is going up. So what do? They create fear, they manufacture a crisis, they point to a technical event, something that sounds complicated and scary, something called the BCI Rebalancing. They hold up this event like a weapon, claiming it will trigger a $6 billion sell-off, claiming the market cannot absorb this selling pressure, claiming that anyone who holds silver right now will wake up poor. But is this true? Is the BCI rebalancing really the catastrophe they claim? Or is it something else entirely? Is this a genuine warning? Or is this the most sophisticated trap Wall Street has set in decades? To answer that question, we need to understand what the BCI actually is. We need to look at the numbers they are hiding, and we need to expose the lie behind the math. The weapon has a name, Bloomberg Commodity Index, 3 words that mean nothing to most people, but to the institutions, to the pension funds, to the sovereign wealth managers, these 3 words represent power, $108 billion of power. And right now, that power is being used as a psychological weapon. Let's talk about what this thing actually is. Imagine a robot, a massive, emotionless, algorithmic robot. It doesn't think, it doesn't feel, it doesn't watch the news or read analyst reports. It doesn't care that silver mines are running dry. It doesn't care that solar panel demand is exploding. It simply follows rules. Rules written by mathematicians in glass towers. Rules that tell it exactly what to buy, exactly what to sell, and exactly when to do it. This robot manages money for some of the most powerful institutions on Earth. The pension fund in California that pays retired teachers, the sovereign wealth fund in Norway built on oil revenue, the university endowment at Harvard that funds scholarships. These institutions don't have time to actively trade commodities. They don't want to hire traders to watch silver prices all day. So they give their money to the robot. They tell it, follow the Bloomberg Commodity Index and don't ask questions. And the robot obeys. It buys a basket of commodities: crude oil, natural gas, corn, wheat, soybeans, coffee, gold, silver. Each commodity gets a specific percentage of the total money. This percentage is called the target weight. And once a year, in January, the robot wakes up. It looks at its portfolio. It checks if the actual weights match the target weights. And if they don't match, it rebalances. It sells what grew too big. It buys what became too small. It does this without emotion, without prediction, without strategy. Just cold, mechanical, algorithmic execution. This is the BCI rebalancing. And this year, something specific happened. The committee that decides the target weights made a decision. They looked at silver, and they said, silver is taking up too much space in the basket. So they issued a new rule. For the year 2026, silver's target weight will be reduced. Last year, the target was 4.49%. This year, the target is 3.94%. On paper, this looks simple. The target dropped by about 0.5%. And this is where the brokers start their script. They say, look, the index is cutting silver exposure. This is bearish. This means silver is going down. They frame it as a vote of no confidence. They frame it as rejection. But here's what they don't tell you. The robot isn't cutting silver because silver is bad. The robot is cutting silver because silver was too good. Let me explain. The index has rules about concentration. It cannot let any single commodity dominate the basket. It cannot let one asset grow so large that it unbalances everything else. And in 2025, silver did something extraordinary. It didn't just go up a little, it exploded. It went from $30 at the start of the year to 40, then 50, then 60, then 70, then 80. It more than doubled, while most other commodities in the basket stayed flat or fell. So what happens when one slice of a pie doubles in size while the other slices stay the same? That slice takes over the whole plate. By December, silver wasn't sitting at 4.49% of the fund anymore. It had ballooned. Through pure price appreciation, silver had grown to nearly 9% of the total portfolio. 9%, almost double what the rules allow. So when the robot wakes up in January, it doesn't see a 0.5% problem. It sees a 5% problem. It sees that silver is currently hogging 9% of the room. But the rulebook says it's only allowed 3.94%. So the robot must sell. It must sell the difference. It must dump approximately 5% of the entire $108 billion fund. Now, let's do the math that the brokers don't want you to do. 5% of $108 billion, that equals $5.4 billion to $6 billion. $6 billion in selling pressure. If you convert that to physical silver at current prices, you're talking about 70 to 78 million ounces. That is almost 10% of the entire world's annual mining production being sold in a matter of days. This is not a small number. This is a leviathan. And this is the number the brokers are waving in front of terrified retail investors. They say, look at this wave. $6 billion. How can the market possibly absorb this? They say, you must sell before the robot does, or you'll be crushed. And if you only looked at this number, if you only looked at the sell side of the equation, you would panic. You would believe them, but there's something they're hiding, something about timing, something about when this selling actually happens. Because here's the thing about robots. They're predictable. Everyone knows when they're going to move. Everyone knows how much they're going to sell. Everyone knows the exact date. And in financial markets, when everyone knows something is coming, smart money doesn't wait. They move first. October 2025. A document was published. A boring, technical, bureaucratic document. The kind of document that most people never read. Filled with tables, percentages, target allocations. But on Wall Street, this document was not boring. It was a treasure map. Because buried inside those tables was information worth billions. The new target weights for the Bloomberg Commodity Index. And every professional trader on earth saw the same thing. Silver's weight was being cut from 4.49% down to 3.94%. The rebalancing would happen in January. The selling would be mandatory. The volume would be massive. Now, here's the question. If you were a professional fund manager, if you controlled billions of dollars, if you saw this document in October, would you wait until January to act? Would you sit on your hands for 3 months? Would you watch the price potentially rise higher, knowing you'd have to sell later? Of course not. That would be financial suicide. In the world of institutional trading, waiting is losing. The moment that document was published, the moment those target weights became public, the game began. Not in January, in October. This is called front running. And it's the most important concept that the brokers are hiding from retail investors. Let me explain how this works. The BCI is not one single fund. It's an index, a benchmark, and dozens of different funds track this index. Some of them are purely passive. They are locked into strict rules. They cannot trade early. They must wait for the official rebalancing date. But others have flexibility. They are called active funds. They track the same index, but they have permission to trade around it. They can anticipate, they can adjust, they can move early. And these active funds, they didn't wait. In November, while silver was rallying towards $70, they started selling quietly, methodically, without announcement. They sold into strength. They used the liquidity of the bull market to hide their exits. In December, while everyone was talking about silver hitting $80, they sold more. Every time the price spiked, they fed shares into the market. Every time buying pressure increased, they took the other side. They weren't trying to crash the price. They were trying to complete their $6 billion exit without anyone noticing. And here's the evidence. Look at what silver did in December. It hit $80, and then it stopped. It didn't go to 90. It didn't go to 100. It consolidated. It paused. It held steady. Why? Because while retail investors were celebrating the rally, while YouTube videos were predicting triple digits, the institutions were quietly selling. That $6 billion wave everyone is afraid of. It already happened. It happened in slow motion, spread across 2 months. The market already absorbed it. The price already digested it. That's why silver didn't explode higher in December. The selling pressure was there, in the background, holding it down. So what's left for January? What's left for this week? What's left for the so-called crash? Only the dumb money, only the strictly passive funds that have no choice, only the exchange-traded funds that must execute on the exact rebalancing date. These funds are small, maybe 2 billion, maybe 3 billion of the total. They are the tail, not the dog. And here's where the trap closes. The brokers know this. JP Morgan knows this. Goldman Sachs knows this. They know that the smart money already sold. They know that the big wave already passed. They know that what's coming this week is just the cleanup, but they're not telling you that. Instead, they're calling you right now, in January, after the major selling is done, and they're screaming, the crash is coming. Sell now, go short. Why? Why are they encouraging you to panic after the institution's already exited? Because they need one final piece. They need liquidity on the way back up. Think about the cycle. The active fund managers sold in December at $85. Now the passive robots sell in January at $75. The price dipped temporarily. And who's waiting to buy? The same active fund managers who sold at $85. They're sitting on cash. They're watching the price. And when the passive robots push it down a few dollars, they buy it right back. They scoop up cheap shares from the mindless algorithms, and they ride the next leg up. But here's the problem. If only the robots are selling, there might not be enough volume. The dip might not be big enough. The opportunity might be too small. So what do? They recruit you, They call retail investors. They spread fear. They convince you to panic, sell your positions, so that the institutions can buy your shares too. You become the liquidity provider. You become the victim in a game that ended 2 months ago. You sell at 75, thinking you're avoiding a crash to 60, but the crash isn't coming because the selling already happened. And 3 weeks from now, when silver is back at 85, you'll realize you gave your shares away at the bottom to the same people who sold at the top. This is the front-running reality. This is the timeline they're hiding. The $6 billion wave was real. But it's in the rearview mirror, not the windshield. The question now is not about selling pressure. The question is about buying pressure. Because while Wall Street is playing paper games, while algorithms are shuffling percentages, while brokers are spreading fear, there's another player in this game. A player who doesn't care about Bloomberg indices, a player who doesn't trade on fear, a player who measures wealth in centuries, not quarters. And that player is watching, waiting, and buying. $7. That's the number Wall Street doesn't want you to see. $7 per ounce, the difference between the price of silver in New York and the price of silver in Shanghai, right now at this exact moment. A bar of physical silver is worth $7 more in China than it is in America. Let that sink in. The same metal, the same weight, the same purity, simply by crossing the Pacific Ocean, gains $7 in value. This is not theory. This is not speculation. This is pure physics. This is arbitrage. And it changes everything. Because while the Bloomberg Commodity Index robot is mechanically dumping paper contracts in New York, while brokers are screaming about meltdowns and crashes, while retail investors are being told to panic, there's a vacuum cleaner on the other side of the world, and it is running at full power. Here's how arbitrage works. If you can buy something for $75 in one place and sell it for $82 in another place, you don't do it once, you do it a million times. You do it until one of two things happens. Either you run out of money or you run out of metal. And right now, China is not running out of money. So every single ounce that gets sold in New York, every single ounce that the BCI robot dumps, every single share that a terrified retiree panic sells, gets immediately bought by arbitrage traders, gets loaded onto ships, gets sent to Shanghai, gets sold at a $7 premium. This is free money, risk-free profit, guaranteed return, and the financial institutions know this. The commodity trading houses know this. The Chinese state-owned enterprises know this. So when the brokers tell you that a $6 billion wave will crash the market, they're lying by omission, because they're only showing you one side of the equation. They're showing you the supply, but they're hiding the demand. Let me explain what happens when the BCI sells. The robot dumps contracts. The price in New York drops from $80 to $72. The shorts celebrate. The brokers cheer. The retail investors panic. But what actually happened? The spread just widened. Shanghai was already $7 higher. Now it's $15 higher. The arbitrage didn't disappear. It exploded. And every professional trader in the world sees this. They see that silver just went on sale. They see that the discount just deepened. They see that the profit margin just doubled. So they buy everything. They buy so aggressively that the price doesn't stay down. It can't stay down because the demand is structural. The demand is permanent. The demand is not based on sentiment or fear or chart patterns. It's based on industrial necessity. China controls 80% of the world's solar panel manufacturing. 80%, and every single solar panel requires silver. There is no substitute. There is no alternative, no silver, no panels, no energy independence, no future. So when China sees Western pension funds being forced to sell silver because of a rule book, they don't panic, they laugh, and then they buy. They buy because they understand something the West has forgotten. Silver is not a trade. It's a strategic resource. They're not accumulating for quarterly profits. They're accumulating for the next 50 years. They see the same geological surveys everyone else sees. They see global mine production declining. They see primary silver mines shutting down. They see reserves depleting. They know that in 10 years, there might not be enough silver to buy at any price. So when a robot in New York offers them a discount, when Western investors panic sell their positions, when brokers create artificial fear, China treats it as a gift. They treat it as wealthy nations voluntarily transferring strategic resources. And this creates what I call the Eastern arbitrage shield. It's an invisible floor under the silver price, a floor made of standing buy orders, a floor supported by industrial demand that cannot be turned off. You cannot crash a market when the world's second largest economy is standing there with an open checkbook. You cannot create a meltdown when every dip gets instantly bought. The BCI can sell $6 billion. The brokers can spread all the fear they want. But as long as Shanghai is paying a premium, as long as Chinese factories need silver, as long as arbitrage traders can make risk-free profit, the price will not collapse. It cannot collapse. And this brings us back to the original question. The question we started with, who benefits? Not from the selling, but from convincing you to sell. The answer is now clear. The major banks, the bullion dealers, the short sellers, they are trapped. They sold 4.4 billion ounces of silver they don't have. Every dollar the price rises costs them billions in losses. Every day they hold these positions. They bleed. The BCI rebalancing was their last hope, their only scheduled event that guarantees selling pressure, their final chance to create enough fear, enough panic, enough volume to cover their shorts before the market breaks them. But it's not working, because the Eastern arbitrage shield absorbed the selling, because the front running already happened in December, because the remaining volume is too small to matter. So they escalated. They picked up the phone, they called retail investors, they used fear, urgency, and sophisticated language to convince ordinary people to provide the liquidity they desperately need. They need you to sell, not because you should, but because they're drowning and they're trying to grab your ankles to pull themselves up. This is not investment advice. This is not a prediction. This is pattern recognition. When institutions that have been silent for years suddenly care about your downside risk, when brokers who never called during the dip start calling at the peak, when the narrative is coordinated, precise, and urgent, someone is trapped, and they need an exit. The rebalancing is real. The $6 billion in selling was real. But the timing was wrong. The impact was absorbed. And the demand is permanent. In 6 months, when silver trades at $150, no one will remember the BCI. No one will remember the January rebalancing. No one will remember the broker calls. They will only remember who sold at 75 and who bought at 75. The transfer of wealth is not random. It flows from the fearful to the patient, from the reactive to the strategic, from those who believe brokers to those who understand supply and demand. The choice is simple. Panic and sell to cover someone else's mistakes, or hold and let the Eastern arbitrage shield do its work. The phone is ringing. The broker is reading his script. The question is not whether the BCI is selling. The question is, who are you selling to? And why do they want it so badly?